Hi guys, welcome back. So we already had a discussion on the net investment calculation and the cash flows calculation under capital budgeting. This time, we are going to talk about the capital budgeting techniques or models. The capital budgeting techniques or models include the accounting rate of return, the payback period, the net present value, the internal rate of return, and the profitability index. For this session, we are going to focus on the accounting rate of return or ARR. The accounting rate of return is the accounting profit generated by a project expressed as a percentage of the investment made in that project. The formula for the ARR is ARR equals to accounting profit divided by the net investment. The net investment can mean the initial investment, that is year zero investment, or the average investment throughout the life of the project. To deal with the calculation of the ARR, let us proceed to the following sample case. A new investment in machinery made by Jupert Corporation cost 800,000, which is expected to be in use for 4 years. Jupert uses the straight line method to depreciate assets. The cash flows expected for these projects are as follows. Year 1, 340,000. Year 2, 380,000. Year 3, 380,000. And year 4, 300,000. Let us calculate the accounting rate of return for this project. So we are going to start with the given before tax cash flows per year. That's before tax cash flows for year 1, 2, 3, and 4. We have the following given. That's 340,000 in year 1, 380,000 in year 2, 380,000 in year 3, and 300,000 in year 4. So, what is given to us is the before tax cash flows. Remember that accounting rate of return is the only method to evaluate our project's desirability that utilizes net income instead of cash flows. As such, we're going to make some adjustments. To arrive at the profit figure, we need to deduct the depreciation expense per year. We have depreciation expense. The project would last for 4 years and it costs 800,000. Using the straight line method, you have 800,000 divided by 4. That would be 200,000 per year. We are going to have the following profit figures. 140,000 year 1, 180,000 both for year 2 and 3, and 100,000 for year 4. These are the profits for each year. Since we have different profit figures for each year, we just need to take the average of the 4. Taking the average of these 4, we are going to have an average annual profit of 150,000 pesos. Let us now calculate the accounting rate of return. So you would have ARR. This is equal to profit over investment. One version of the ARR would utilize the initial investment as our denominator. So we're going to use that first. You have a profit of 150,000 every year divided by the investment of 800,000. This would give us 18.75%. The accounting rate of return based on initial investment. The second variant of the ARR is one that is based on the average investment. So if the initial investment is 800,000 and at the end of the project's life, it would be fully depreciated, well, we would have 800,000 plus 0 divided by 2. That's an average investment of 400,000. So we would have an ARR based on the average investment. This is equal to 150,000. And again, the average of 800,000 in the beginning and presumed to be 0, the salvage value at the end of the project life. That is an average of 400,000. 150 divided by 400,000, this is 37.5%. The accounting rate of return is very intuitive. It's very easy to understand. Well, for the given amount of investment, what percentage would go into profits? That is what the accounting rate of return means. However, it suffers two major drawbacks. Number one, it is based on accounting profit instead of cash flows. We already had a full discussion on this in the previous session. Cash flows are a better indicator of performance compared to profits. Number two, it does not account for the time value of money. As a result of these two drawbacks, we can say that the accounting rate of return is the weakest of all capital budgeting models. Despite the ease in understanding, this is still the weakest model. It is in my opinion that we should use the accounting rate of return only for purposes of evaluating the impact of the project on the financial statement ratios, especially return on asset and return on equity. But other than that, to really use as a basis for decision making, accounting rate of return is a weak tool for such purpose. Let us now proceed to the next capital budgeting technique. We have the payback period. Unlike accounting rate of return, the payback period would utilize cash flows together with the other capital budgeting models. Payback period. This is the time period needed to recover the investment. It is a measure of a project's liquidity, that is, the ability of the project to be back to cash or cash convertibility. For the calculation of the payback period, as well as the interpretation, let us proceed to the next sample case. A new purchase of machine to be made by Marsma Corporation cost 500,000, which is expected to be in use for 4 years. Marsma uses the straight line method to depreciate assets. The profits to be earned from this machine are as follows. Year 1, 100,000. Year 2, 130,000. Year 3, 75,000. And year 4, 65,000. So let us consider the profits that's expected to be earned every year. 100,000, 130,000, 75,000, and 65,000. When calculating the payback period, we're actually not interested with profits. Again, all other models would utilize cash flows. We want to know how long would it take for an investment that we have made to be recovered back in the form of cash. That's what the payback period is all about. So rather than rely on the profit figures, we are going to use the cash flows. So remember, if what is given is the profit, just add back the non-cash expense. Yes, that's depreciation. So let us calculate the depreciation to be added back to profits in order to arrive at the cash flows. We have a cost of investment of 500,000 capitalizable, 4 years. That would be 500,000 divided by 4. So every year, the depreciation expense is around 125,000. So we would have the following cash flows every year. Year 1, that would be 225,000. Year 2, that's 255,000. Year 3, that would be 200,000. And year 4, we have 190,000. So what's the payback period? The payback period is the time period needed to recover the investment. So we are going to analyze this 1 year at a time. So when we have an investment of 500,000, this is the year 0 outflow. In year 1, we are expected to generate 225,000. This is the cash flows that would be generated in that year. So that's 500,000 less 225,000. Well, at the end of the first year, we still have 275,000 unrecovered. So 1 year is not enough to recover the investment. Let's go to year 2. In year 2, it's expected to generate 255,000. By the end of year 2, we would have still unrecovered cash flows of 20,000. Now, there's 20,000 more to recover. If we're going to spend another year, that's year 3, we're expected to generate 200,000. This is more than enough. This is more than enough time to recover the investment. So we do not need 3 years. What we would need would be 2 years plus a fraction of a year. We are going to make an assumption. We're going to make an assumption that the cash flows generated in 1 year are evenly distributed throughout that entire year. It is generated evenly throughout the year. So for this 200,000 in year 3, we can assume that every day we're going to have 1/365 of this amount. In such a case, we do not need 3 years. We only need 2 years plus enough time to recover only 20,000. So if we need 20,000, and in this year we will generate 200,000, we only need 0.1 of that year. So the payback period is 2.1 years. What does this figure mean? This figure simply means from the time of investment, it would take 2.1 years to recover that amount of investment. Does it say anything about the project's profitability? No. It doesn't say anything about whether this project is going to earn us or it will give us losses. It doesn't say anything. What it simply tells us is that it would take 2.1 years to recover the investment amount. What we have calculated is the traditional payback period. There are also other variants of the payback period. This includes the bailout period. This assumes that the project is terminated if all invested cash flows are recoverable. In that case, we're going to consider the salvage value, if applicable. 2, we also have the discounted payback period. This accounts for the time value of money in calculating the payback period. In such a case, we would need present value factors. Now, the payback period is actually a good tool in measuring liquidity. That is, again, the cash convertibility of the project. However, it suffers the following drawbacks. It ignores the time value of money. With the exception of the discounted payback period variant, payback period ignores the time value of money. Actually, it's both payback and bailout period. And aside from that, as mentioned a while ago, it ignores the profitability of the project. It just tells us how long it would take to recover the project, but it doesn't tell us whether the project is profitable. Now, how are we going to evaluate the payback period? Well, We want a shorter payback period. We want to quickly recover the cash invested. So to evaluate using the payback period, we would want a payback period as short as possible. The shorter the payback period, the better. In the next video, we are going to talk about the discounted cash flow techniques. These are the techniques that would account for the time value of money. Until then, like, share, and subscribe.